If you want to get great at something, you may as well learn from those who've already been to the top and proven themselves, and in the investing world, it's no different. Why make loads of mistakes all on your own that could cost you loads of money when you can just avoid them entirely? So that's why I've put together 10 investment tips from some of the greatest investors in the world. Let's get started right from the top in no particular order. Peter Lynch once said, "Never invest in an idea you can't illustrate with a crayon." Now, I don't know about you, but it's been quite a few years since I've had to use crayons, and I can't actually find any in my house, but I think you get the idea here. Lynch is suggesting that you need to understand your investments to a good enough level that you can basically explain it to a child without any fancy charts or any complex jargon. It's the same idea for lots of complex subjects. If you can't explain it to a child, then you probably don't understand the concept enough. So for example, if you're invested in Apple and someone asks, "What do?" you can easily say they make smartphones and computers and other devices, and they just sell them all around the world. And you can do it with whatever little crayon you want. Now, it might seem like common sense, but it really starts to make sense, especially during hard times. If you don't understand how your stocks actually make their money, then how are you going to understand if sales are dropping because the economy's bad or just that the company's doing poorly? And it works the same with the competition. How are you going to know who the competitors are if you don't really know what they do? Now, I've definitely been guilty of buying stocks in the past, not really knowing enough about them. And it's all good when the stock price is going up, but when things are tough in the market like they are now, you won't sleep very well if you aren't really sure if it's a business doing badly or something else is going wrong. This advice is from the legend himself, John Bogle, the founder of Vanguard, who created the first low-cost passive index fund that everyday people could invest in. When he says keep your costs down, he's not saying that you need to cut back on Starbucks coffees or stop buying new trainers. He's talking about the cost that you have as an investor. You see, over many years, if you're a long-term investor, your fees and charges that you've got to pay can really add up and make a huge difference to what you actually end up with. I'd highly recommend John Bogle's book on simple common sense investing. With the power of magic, it should appear right on screen for you there. There's loads of examples in it talking about costs, but in short, here's a great one. Let's imagine two people over a lifetime worth of investing. Now, one person has costs of 0.5% per year, and the other person's got costs of 1.5%. So maybe that person is using a financial advisor or even investing in some fancy mutual funds that apparently will beat the market. Now, let's say that both investors get back exactly the same over 20 years, so their returns are the same before fees. So how much difference would just 1.5% really make? Surely can't be that much. Well, let's have a check and see. If we just say they invested £500 a month for 20 years with a 10% return per year, we end up with £383,000 and a little bit of change too. Now, for investor number 2, with their higher fees, let's now take off 1.5% from the 10% and see what actually happens when they only make 8.5% return per year for the same period. Your return goes down to £316,000, which is nearly £70,000 worth of fees, almost 20% less over those 20 years. And when you work out per year what the cost has actually been, it's been £300 a month. So about £3,000 a year, not in your pocket, but in someone else's. So listen to John and keep your costs low. Okay, let's turn to the master himself now, the Oracle of Omaha and the man that every investor loves to quote, even though they often totally try and spin what he says to suit their own weird behavior. I think this advice is great because it addresses a really important point about investing, in that you really need to be in this for the long term if you want to be serious about building your wealth and making money. You need to be thinking in decades and not just in months or years. Let's say that you found a company you like and you think they're going to do very well. That business could be the best in the world at what they do, but in the short term, the stock market could make all kinds of moves. If you've watched the stock market this year, you'll know exactly what can happen in the short term. And as the saying goes, the market is a voting machine in the short term, but a weighing machine in the long term. By thinking long term, you'll hopefully spend a bit more time on the decision and you'll give yourself a much better chance at making money. Now, although we can't know the future for individual companies, here's what happens when you invest in the long run in the stock market. Pretty much, the longer you invest, the greater your chances are of making money and not losing it all. So I think it's fair to say that none of us probably learned anything to do with personal finance and investing at school, and that's at least in my case, and also nothing from my parents as well. The only thing I was good at was trying to ask them for money all the time, but I can tell you I wasn't very successful at that. Robert Kiyosaki is famous for his book Rich Dad Poor Dad, and it's sold millions of copies all over the world. And although he's probably gone a bit too far towards predicting the end of the world and stock market crashes every other week now, what he did teach us was definitely useful, and although it might seem obvious, this is really important. Basically understand how money works. Know the difference between an asset and a liability. So something that costs you money and loses it. So for most people, a big liability would be a car payment. And unless you've somehow got some rare supercar, it'll be losing money every month with depreciation. Whereas an asset, on the other hand, might be your investment in the stock market, something that over time should beat inflation and actually create a bit of wealth for you. As well as understanding this and not wasting all of your money trying to look rich, it's always a good reminder to know what the rich do and invest in as many assets as you can so that eventually over the long term, you can then have the freedom to do pretty much whatever you want. Don't also forget the basics too. You can't invest a single penny if you don't save money in the first place, so work on spending less than you make and then you'll put yourself in a pretty good spot. Right, let's jump back to John Bogle for this one. If you want to understand some of the basics of investing, then you need to understand what index funds are and how powerful they can be to help grow your wealth. One of his great quotes was, "Don't try and find the needle in the haystack, just buy the haystack." And this was when he was referring to the stock market as one big haystack compared to finding that one great company being the needle. Now, I can rattle off so much data here about why index funds are great and how much of a game changer they've been for investors, but let's not get into too much of that detail. Instead, I'll remind you of a couple of important things. One, us humans on average are pretty rubbish investors when we're trying to make ourselves some money. Unfortunately, our little monkey brains cause all kinds of issues and we make silly decisions all of the time out of fear, greed, or because we woke up on the wrong side of the bed. In fact, the average investor makes very bad returns when you look at the data. They buy near the top and all the excitement, sell near the bottom when everyone's sad, and they're always chasing the latest fad. If you think you're somehow immune and you don't act like that, go grab a mirror and you'll see. And two, even the professional funds and money managers find it really hard to beat a passive index fund in the long run, and even in most years. You can check on these stats every year when they're published and put it this way, they don't look very good for the suits, and you can do very well if you just stick to this strategy, and I have it as a core part of my own and I'll not be changing anytime soon. For more videos on this topic, I've done loads on my channel. Don't forget to subscribe for more, and while you're there, please drop me a like. It does really help out small channels like mine. Now, on to the next tip. Okay, so as much as index funds are great, let's not pretend that some of the best in the business of investing actually prefer to pick their own stocks. Now, if you're going to do that, and same like me with a smaller part of your portfolio, then you won't go wrong listening to the man himself, Warren Buffett. So we know he's a fan of holding businesses for a long time, but he's also a fan of making sure he buys quality businesses and not just ones that look cheap. In Berkshire Hathaway, Buffett and his partner Charlie Munger have built a multi-billion-dollar empire sticking to these principles, and they'd much rather pay a premium for a great company than buy one just because it looks cheap. And a great example here is a stock like Coca-Cola. It's been in their portfolio for decades. It's not exactly an exciting tech stock that promises to change the world, and you could say that anyone would be able to copy the product. It's not too difficult, but with a strong brand, lots of different lines of business, and a proven track record, Coca-Cola is an amazing business with a really strong moat that survived through recessions, stock market crashes, and pretty much everything else in between. So don't forget to look for quality companies, not just those old cigar butts on the floor. Sometimes they're cheap for a reason. Okay, let's head again to Peter Lynch because he's had some great quotes over the years managing one of the biggest hedge funds in the world at one point. This is a reminder that you've got to fight that part of your brain that always likes to invest in hindsight. It's always easy to look back and say, I wish I'd bought here and sold here, or if only I'd gone with my gut that one time. This advice from Lynch is again a reminder that investing is just as much about controlling your own emotions as it is picking the right investments, because it's never just a simple journey. It's a lot more like getting on a roller coaster, but you could be doing a loop-the-loop, a corkscrew and a jump all within a few seconds. So stop worrying about investing too late or feeling regrets, focus on what you can do now and keep those long-term blinkers on. This might seem harsh from Warren Buffett's right-hand man and fellow Berkshire Hathaway owner, but he's completely right here with a reminder that if we want to enjoy the rewards of investing, then we've also got to put up with the risks too. Having stock prices fall and crash are all part of the normal chaos of the stock market. Crashes happen every few years, corrections happen all the time, and it's not a straight line up as it might have seemed over the past couple of years. Even some of the greatest companies we might consider today as inevitable giants have usually seen their share price crash or drop massively in the past. You don't have to go back very far to see stocks like Amazon crash more than 90% from their peaks back during the dot-com bubble. And companies like Cisco have actually never returned to their inflated peaks from during that time. However, going back to Amazon, even if you'd gotten super unlucky with buying right at the top back then, you can hardly even see the dip on the long-term price chart, and you would still be up by 30 times over 3,000%, still beating out the S&P 500 by a huge margin. So take it from Charlie, be prepared to see your account in the red by 50% if you want to invest, or don't bother investing at all, because that is just the price of admission. Now, if you do lose all your money by investing in terrible companies, sorry, can't help you there. Right, Bogle's back, and this one is timeless. I can't stress enough just how important your emotions are in deciding your fate as an investor. You've only got to see the knee-jerk reactions of some of the stock market and the crazy behaviours of the past to see how much is driven by fear, greed, and pretty much everything else in between. Emotions affect everyone, regardless of how experienced they might be, but the best investors are the ones who can put a process in place to make sure that they don't end up following their instincts. Whether that's only buying stocks after a cooling off period or a couple of days, placing orders outside of stock market hours so you don't look at the prices, or even just buying an index fund every single month without fail, any way you can take your emotions out of the game will serve you very well. All of the data we have on this subject shows just how bad things can get if we let our heads get in the way, and it's what leads to the same old story of selling at the bottom and buying all the way to the top. So find something that works for you, maybe take a walk every time you go buy something, go get a goldfish you can feed, or just have a couple of games of Call of Duty. But whatever you do, do something. And here's the last one for you, and it ties nicely back to Peter Lynch's first tip. You have to do your own research, because investing makes you a part owner of business, and you should really spend some time trying to figure out what you actually own. Peter uses this example when he talks about people's investing decisions. He says that most people spend more time deciding on the colour of their fridge or their toaster than they do about their stock choices, and that's pretty crazy when you think about it. Or they're more worried about saving a few pennies on something that really doesn't matter, but they'd happily throw thousands of dollars into an investment because one of their friends recommended it at a dinner party. If you really want to be a great investor, you have to find an edge. Warren Buffett said that he would spend most of his day just sat in his office reading and researching, and it was the same with Peter Lynch. Back in the day, they'd visit company offices, visit stores, get as much data and literature as they could, and work out if it's actually worth an investment. And if you're not prepared to do that, then just stick with index funds or something like that. Life is a lot less stressful that way. And talking of investing right now and getting started, watch this video next if you want to know if you should get started now or you should wait. Anyway, drop me a like on the way out, subscribe for many more, and as always, happy investing.